Some investors want steady dividend income, others are chasing growth, and some want to spread their money beyond the United States for diversification. But if you had $100,000 to invest today, where would you put it? That's exactly the question John is trying to answer. So, he takes the same $100,000 and puts it into what he believes are the best ETFs for three very different goals: one built to generate income, one designed for growth, and one that gives him international exposure. One of these funds could eventually pay him around $14,000 every single month. Another could turn that same $100,000 into nearly $9 million. And the international ETF offers something the other two simply can't. Then, by the end, you'll see how John combines all three into a single portfolio projected to grow beyond $3 million, while still producing more than $4,000 a month in dividend income. But before John invests even a single dollar, he does something most investors never do. He stops, and he asks himself a simple question: what do I actually want my money to do for me? So, he writes down three questions. Question number 1. Do I want the highest income possible? Real cash landing in my account every month. A paycheck created by my investments. Money that shows up, whether I work or not. Question number 2. Do I want the biggest account possible? The largest balance. The number on the screen that makes you sit back and think, wow, I actually did it. And question number 3. Do I want my money invested in places most American investors never even look? Not just the United States, but Europe, Japan, Australia, and global companies that millions of US investors never own. Here's where things get interesting. The fund that gives you the biggest paycheck isn't the same fund that gives you the biggest portfolio. Not even close. They're completely different answers. And international exposure? That's another answer entirely. That's why John isn't searching for one perfect ETF. He's looking at three. One built to pay him, one built to grow his wealth, and one designed to take him beyond the US market. Now, it's time to see what happens when he puts $100,000 into each one. John starts with income, the ETF built to pay investors while they own it. It holds companies you already know: Coca-Cola, Chevron, Pepsi, Verizon. They're not flashy. They're not exciting. But they are profitable businesses that have rewarded shareholders with dividends for decades. John's income ETF owns around 105 companies. It's called Shoot, the Schwab US Dividend Equity ETF. And getting into Shoot isn't easy. Every company has to pass a strict screening process, at least 10 consecutive years of dividend payments, a proven history of increasing those dividends. Strong financial health, healthy cash flow, low debt, real profits. Out of all the dividend-paying companies that qualify, only the top 100 make the cut. SHTI has one primary job: generate income. Any growth in the share price? That's just a bonus. But to understand why SHTI works, you have to understand dividends. Because without this part, the entire story falls apart. When a company earns a profit, it has two choices. It can reinvest that money back into the business, or it can return part of those profits to shareholders as dividends. The companies inside SHTI choose the second option. Every quarter, those dividend payments flow into the ETF. Then the ETF distributes that cash to investors like John. And over time, two things begin to grow: the share price and the dividend itself. As dividends increase and get reinvested into buying additional shares, those new shares generate even more dividends, which buy even more shares. That's the engine. That's the power behind the strategy. So, what happens when John invests $100,000? SHTI starts with a dividend yield of 3.29%. It has a 10-year dividend growth rate of 10.43%. and average annual share price appreciation of 9.25%. That dividend growth rate does most of the heavy lifting, because while the stock price is rising at 9.25% a year, the dividend itself is growing even faster. And that's what transforms income over time. John invests his $100,000 into SHUD. After just 1 year, the account grows to approximately $112,540. By year 10, it reaches $331,146. By year 20, it climbs to $1,139,327. And by year 30, the projected value reaches $4,091,465. Nearly $4 million in gains. About $2.73 million that comes from rising share prices. The remaining $1.26 million comes from reinvested dividends. Dividends buying more shares. Those shares producing more dividends, and those dividends buying even more shares. But here's the thing, the portfolio value isn't really the story. The income is. By year 30, SHT is projected to generate $166,111 a year in dividend income. That's roughly $13,843 every single month after month, without John lifting a finger. And this is where it becomes truly remarkable. The companies inside SHT don't just pay dividends, they consistently increase them. Watch what happens to the income generated from John's original $100,000 investment. Year 1, $390. Year 5, $5,543. Year 10, $10,724. Year 20, $41,322. And by year 30, $166,111. It's still the same original investment. The difference is that the businesses themselves continue raising what they pay shareholders. Pretty incredible, isn't it? But SHT only answers John's first question. There are still 2 left. The next ETF takes the same $100,000 and turns it into more than twice SHT's ending balance. And later, you'll see how John combines all 3 funds into a portfolio projected to exceed $3 million, while producing more than $4,000 every single month. But first, it's time to answer the second question. What if John's goal isn't income at all? What if all he wants is the biggest portfolio possible? The answer is QQ, the Invesco QQQ Trust. It tracks the NASDAQ 100, the largest non-financial companies listed on the NASDAQ exchange. Apple, Microsoft, Nvidia, Amazon, Meta, Google, Tesla, the giants of American innovation. QQQ isn't purely a technology fund. Companies like Costco, PepsiCo, and Honeywell are there too. But make no mistake, the technology giants drive the majority of its returns. Before looking at the projections, though, there's something important to acknowledge. Over the past decade, QQQ delivered average annual share price appreciation of 20.96%. Those returns are real. But if you project that same number forward for 30 years, $100,000 turns into nearly $31 million. Technically, the math works. Realistically, it's difficult to defend. Technology has experienced an extraordinary run, one unlike anything we've seen before, and no index grows at 20% a year forever. So for this analysis, John uses a more conservative assumption. 16% annual appreciation, closer to QQ's long-term average. Still aggressive, still growth-focused, but far more realistic over multiple decades. Under those assumptions, QQ delivers a dividend yield of just 0.40%, dividend growth of 9.12%, and annual appreciation of 16%. Unlike SHT, income barely matters here. Growth is everything. And the numbers reflect that reality. John's $100,000 grows to approximately $116,400 after 1 year. By year 10, it's worth $452,544. By year 20, it reaches $2,221,513. Then something extraordinary happens. The compounding effect accelerates. Fast by year 30, the portfolio is projected to reach $8,972,680, almost $9 million. Out of the total gains, roughly $8.83 million comes from capital appreciation. Only $47,000 comes from reinvested dividends. QQ engine is driven almost entirely by rising share prices. And when it comes to income, the story changes dramatically. By year 30, QQ is projected to generate just $3,914 a year in dividends. That's around $326 a month, even with a portfolio approaching $9 million. Compare that to XT's projected $166,111 in annual income, and QQQ produces 42 times less cash flow. So when the goal is maximizing portfolio value, QQ wins by a landslide. If John's priority is building the biggest account possible, QQ is the clear choice. The trade-off? Very little income, and every dollar remains invested within U.S. borders. Which leaves one final question unanswered. What about international investing? Many American investors treat international exposure like a chore, something they own because textbooks tell them they should, not because they expect it to deliver meaningful results. But John is about to discover that the textbooks may have underestimated its value. His final choice is ETFs, the iShares Quorum C ETFs.